Start.
Hello, our dear learners and friends of RCM. You're most welcome for the RCM online tuition or tutorials. My pleasure also to introduce myself. My name is Gabriel Orina, and I'll be your financial reporting tutor. I'm also proud to say that we are a team, a strong team with other tutors, and I'm proud to be part of such a strong team and such a strong organization. The first session, I'm going to discuss with you, this is financial reporting for CPA Part 2, Section 3. The first session, I'm going to discuss with you about the regulatory framework of financial reporting. Yes, I'll also use this to know if my handwriting is friendly, readable. The title there is the regulatory framework of financial reporting. You know that the main task of the accountant is to provide a presentation of financial statements for users who are both within the organization and outside the organization. That is the main thing, and it's the right thing to talk about first because it sets the goal and it sets the pace of learning financial reporting. The first thing to understand is that accounting has a framework. That is, it's done within a certain background with certain aims and objectives. So the first thing is understanding the regulatory framework of financial reporting. Then later, we'll try to understand what you call the conceptual framework. Now, the two of them, the regulatory and the conceptual framework, make up the total of what we call the framework of financial reporting. They're big topics, so they'll have to be discussed separately. First, what is the meaning of the term here, regulation? Now, to regulate means to set certain guidelines and also lay down certain benchmarks against which an activity will be evaluated and to which those activities must conform. So the work of the accountant must conform to certain guidelines and benchmarks. And those guidelines and benchmark is what we are calling the regulatory framework of accounting. So accounting must be regulated in order to conform to certain expectations or requirements. Why do we need regulation? Okay, first, accounting is determined in two ways. There is the conceptual framework and the regulatory framework. The conceptual framework is about applying certain principles. We call them principles of accounting or generally accepted accounting principles. Then the second framework is the regulatory framework. This is something that is laid down very rigid and which has got to be followed and which is very, very formal. We call it the regulatory framework. We need then to understand why we need a regulatory framework and then also why we need a conceptual framework. So first is the need for a regulatory framework. I'll put it this way. Accountants have gone to school. They have directors in a company to watch over them. Why do they need a regulatory framework? That's what we will discuss here. How does having a regulatory framework help to enhance the work of the accountant and the results that we get from the accountant's work? So we have certain things that we have to consider. Because accountants have gone, to school in different places, they have different backgrounds of experience, we require that they have a common reference. So the first thing is that framework is a source of reference. The reason we need a reference is that we speak the same language as accountants. We look at things the same way, we define things the same way, and we do it the same way. So for that to happen, we must have a common reference, and that reference is partly the regulatory framework. Then we also require to ensure that financial statements, or what we call financial reporting, will be relevant and reliable. The financial statements or financial reports send signals about the organization, about its performance, its financial position, its cash flows. So those statements must contain information that is relevant. That is, you give the users of information what they want to read and what they want to hear, not what you wish to give them. So the regulatory framework defines what type of information we have to give the users of financial statements so that their needs, the information needs, can be fully met and satisfied. So for that to happen, we need a framework. Then there is the factor of uniformity. Yes, accountants are doing the same thing, so they should do it the same way. And to ensure they do it the same way, they must have a common place for reference with rules, guidelines, and benchmarks. That means that 2-3 accountants preparing financial statements for the same company should come up with the same results. That way, people will learn to take accountants seriously. The financial statements they present become acceptable and very credible. Then the other thing is prevent manipulation of information. See what happens. There are different persons. Some would wish to twist or manipulate the information about the results of the company, how the company has performed, what the company owns, the resources. Someone would want to project a different picture, perhaps a much better picture than what there is. That is manipulating the information. But because financial statements are prepared using a given framework, which is defined, the methods, the approaches, the standard of work that is expected, it becomes difficult for anybody to manipulate those financial reports. So you can see it's very important that we have a framework which will guide accountants. Not only guide accountants, also bind them, because some might want to do some very creative accounting and mislead the users of the financial statements. Next is, what is the scope of that framework? That is what I'm going to next. Of the meaning, we need to know the scope of the framework. What does it cover? Or where are these rules and regulations making the framework? Where are they contained? The first one that should come to mind is accounting standards. Yes, suppose that each one of you has gone through a course in financial accounting, as the procedure is in our examinations, whether you did it at undergraduate level or you did it at CPA Part 1 level. So you know you already have that outline of what standards are accounting standards. Here we have international accounting standards, international financial reporting standards. They are both accounting standards. The difference that this is the earlier generation of standards which are still in use, and this is the new and upcoming generation of standards. So one of the parts of a regulatory framework is having accounting standards, which have been issued or prepared by professional bodies. We'll be talking about International Accounting Standards Board shortly. What do these standards contain? They contain methods and approaches. The methods and approaches that accountants must use when they are preparing financial statements. So this gives them, not only informs them, but it also binds them as to how they're supposed to approach the preparation of financial statements. And most importantly is to give us guidelines about how to achieve true and fair view when we are preparing and presenting financial statements, how to achieve that overall aim of ensuring that financial statements are giving the true and fair view of the performance of the company, the financial position of the company, and the cash flows of the company. The other aspect, the other component of this framework is the company law or legislation. Now, every country, rather every state, has got economic laws which govern how business entities, how public sector organizations must act when they are going about their business. This extends to how the companies also present reports about themselves, what reports they must present, how to present those particular reports, and what information the reports must contain. In Kenya, for instance, we have the Companies Act. Now, the overall purpose of the Companies Act is to regulate companies, that is, organizations registered as limited companies in Kenya. One important relationship between that particular law, the Companies Act, and accounting or financial reporting is that the Companies Act requires that every company in Kenya must prepare and present financial statements. Then it also gives you the minimum requirement for those financial statements. There must be some minimum standard of quality and information that those financial statements you prepare must satisfy. If that is not done, then that company risks closure. That is the registration. So the company law also does adopt, or rather, it does give authority to the accounting standards. Requires that when you prepare financial statements in Kenya, one criteria is that these financial statements must be in accordance with the standards. You can see there's some harmony between the accounting standards and the law. You know, the two work hand in hand. So every company is required at the end of each financial, each accounting period, to present financial statements, have those financial statements audited. A copy is given to the registrar of companies. A copy is retained at the company's offices, and so on and so forth. So it reinforces, this is what I'm saying, the national laws reinforce the application of those standards. Then we have the stock exchange. Beg your pardon. Okay, every country will have a mechanism for regulating its companies, particularly in terms of the companies selling shares or inviting persons to buy their shares, because there can be a lot of fraud. There can be a lot of dishonesty. So there must be some laws regulating how companies act when it comes to issuing shares. In Kenya, for instance, we have the Nairobi Securities Exchange. In other countries, they call it stock exchange. We call it Nairobi Securities Exchange. Why do we have that government body? Is to ensure there is proper discipline among companies when it comes to the issue of shares. How does this relate to accounting? Among the stock exchange regulations are certain requirements that when a company is presenting financial statements, it must disclose certain information. Yeah? There are certain aspects of information that it must disclose so that the persons who are going to buy shares or acquire shares in that particular company are able to understand fully the performance, the financial position of the company, and any risks that they will be taking by buying shares in that particular company. So disclosure of certain information is required by the Securities Exchange regulations. Back to international accounting standards and IFRS. We have seen the framework. One aspect that is not an independent framework but is connected with those three is what we call the professional ethics or professional guidelines, that accounting as a profession has members, and those members are guided by professional standards, guidelines, yeah, that we call professional ethics. They are connected, very closely connected with the standards, the Companies Act, and the Stock Exchange regulations. Let's very briefly talk about the standards, the International Financial Reporting Standards. First of all, these are rules and guidelines which have been laid down by a professional body. The body is International Accounting Standards Board, to guide accountants in what? Preparation and presentation of financial statements. Now, for examination purposes, you may be asked about the uses of IFRS or the advantages of IFRS and the disadvantages. So better discuss a little bit about that, about uses of IFRS. That is, when the International Accounting Standards Board prepares a standard, what exactly they have in mind? One is to bring about global uniformity, in financial reporting. And the manner in which accountants in Uganda, Kenya, Sudan, US present financial statements should be largely the same. Now that makes it easy for people across the globe to be able to understand financial statements regardless of where they're being prepared. Then there is the aspect of high quality financial statements. Because the standards give us methods. They also give us approaches that we use to prepare financial statements. Accountants make fewer mistakes and they come up with very high quality financial statements. They also intended to achieve clear and complete information that the preparers of financial statements are obliged to ensure that they provide all the information there is, all the important material information there is about the company without keeping any information back, and not add any information, and also use a particular language. So the standards also give us the language. They give us the words that we are expected to use in accounting for given assets, liabilities, incomes, expenses. So globally, we are all able to understand, read the financial statements, understand them exactly the same way. So that aspect of clarity is very important. Then the standards give us a benchmark for what will be regarded as true and fair view. because the overall purpose of financial statements is to provide the users of those financial statements with information about the true and fair view of that entity. The standards then give us guidelines as to how to be able to achieve. That is, what must we do? Which rules must we use in which particular situation? How to deal with particular problems to ensure that the information we get gives us or gives the users a true and fair view. Another very important thing is when you prepare financial statements in Kenya, you are not restricting the usage of those financial statements to our borders. The financial statements are going to be read, understood, and applied in decision making beyond the borders. There are investors in China, in UK who are waiting to invest in Kenya. So what they rely on, financial statements of our companies. Equally, these Kenyan companies will want to list their shares in the stock exchanges around the world. List some shares in Nigeria, in South Africa, etc. Now, what then is important is for you to be able to list these shares in the best stock exchange or stock markets. You need to be able to understand that economic environment, and you understand that environment by looking at financial statements of different companies across the globe. Now, that is what makes it easy for you to be able to list, to have your shares listed in the correct country where you can get the best returns. So the financial statements then must be prepared in a standard way across the globe to make that cross-border, we call it cross-border listing, become much, much easier. So it's important that IFRS be applied when we are preparing financial statements. A big topic it is. We'll give you a lot to read, but what you're going to read is a clarification, just a further explanation of what I've been explaining here. For now, I can take you through the application of these standards very briefly in the preparation and presentation of the financial statements. Now that is what I'd want us to see briefly. You'll see tables there showing the presentation of financial statements that I've been talking about. Yes, the accountant armed with knowledge of IFRS, the Companies Act or company legislation. The accountant armed with knowledge of IFRS, equipped with accounting skills, guided by the company's policies, presents financial statements which are to be presented to auditors to audit, bring back, and then distribute to the users to read, understand, communicate, and also make decisions. So what is the impact of the standards now on the work of the accountant? The first that we are able to discuss right now is the presentation factor. That financial statements, first of all, the scope of financial statements has been defined by the standards. The standards will determine what are the different reports, financial reports we prepare, which we call financial statements. What are the titles of those reports of financial statements? What is the content of each of those financial statements? Yes. And what is the language, the terminology that is used in terms of the elements of information that will be found in those financial statements? For that matter, we start with an example here. I've given you an example, XYZ Limited. Now this is actually adapted from the standards, and the standard here is International Accounting Standard 1, IAS 1, about presentation of financial statements. The first standard is a picture of what the financial statements look like and what language is used in preparing those financial statements. So Here we have a chance then to go through this very fast. So we also need to keep that image, because every time you'll be preparing financial statements at this level, you just have to follow the standard. It's called a standard because we have to do things in a certain uniform manner. Take an example. If we're preparing financial statements for the year 2016, we prepare the financial statements for 2016, but also keep looking at what happened in 2015. That is comparative information. So the first thing is there'll be financial statements, but there'll also be comparative information for the previous period. But the focus is on the current, like let's say 2016. The information, the way it's arranged, we have the revenue, cost of sales, and gross profit. At this level, you may not have a problem understanding what each of those means. The sales is revenue, for example, is sales, but it can also be revenue from services or revenue from investment income. Then we have gross profit, other incomes. Now, other incomes will be incomes other than the main product of the company. The main product of the company is like, let's say, sales. That is the main income earning line. Then we may also have other incomes, distribution costs, like cost of transport and advertising and whatever, administrative expenses, the cost of the day-to-day running of the business. We have other expenses, that is miscellaneous, finance costs like interest, yes, share of profit of associates. This is, as we shall see later, when one company invests in other companies, it does get profit, a share of profit from those other companies. One such type of arrangement is called an associate, another company associated with our company that pays us dividends, gives us dividends every year. Okay, profit before tax, income tax expense is deducted to give us the profit for the year. Now the profit for the year is also called the net profit. Profit for the year stands for the profit from the ordinary. Ordinary is normal. Normal is what is expected activities of that organization. For example, if you're running a transport company, you're collecting fares every day. Now, that aspect of providing transport and collecting fares is summed up in terms of your operating activities. But if you earn income in other ways, if, for example, you had a fleet of vehicles, you may sometimes exchange those vehicles old for new vehicles and generate certain income in that process, certain gains. We may not necessarily include those gains under the operating profit. We may create a different heading. We have an additional heading here for other comprehensive income. That is items which are not classified above, which are not classified in the above area. That is, which are not part of the profit for the year, but they are gains and losses, gains and losses. One example that you already know from financial accounting, or financial accounting 1 in the case of the undergraduate studies, we call financial accounting 1, in CPA we call it financial accounting. One such gains or incomes is the surplus on revaluation of an uncurrent asset. Like let's say you revalue a building or land and find that the market value has gone up. Because you're not receiving any assets or any benefits in the form of money or other assets from that gain, that amount is reserved. And it's reported under other comprehensive income. After you reported the whole income of the business, the next thing is, to whom does this total income, to whom does this total income belong? Or to whom is it attributed? A company is a big place. It's a very big entity. It's complex. And complex in the sense that it has got shareholders who are companies, shareholders who are individuals, etc. Now we have different classes of shareholders. One group of shareholders, we call them the parent. One group of shareholders, we call them the minority interests or the non-controlling interests. So the manner in which the profit there is going to be divided between the parent or the parent company that is the owners of the parent company, and the way it's going to be distributed to other what we call non-controlling interests must also be displayed in the statement of profit or loss and other comprehensive income. Now, take note of this, that this statement is divided into two very distinct parts. There is a part we call the profit or loss. Yeah, there is a section called profit or loss, and there's a section which is called other comprehensive income. Profit or loss is the one which ends with profit for the year, which deals with normal, ordinary activities. Then other comprehensive income is that unusual, those unusual occurrences that do not bring about income that is already realized, that is income that is shareable. Like when I talked about the mere increase, appreciation that is, in the value of our building or value of our piece of land as a company, that does not immediately bring distributable income, and therefore it must be reported independently. So the distribution between the shareholders of that profit, or the division of that profit between the different shareholders, is the last thing that is displayed. Now the next statement. The next statement on the page marked 4 is a statement of changes in equity. We are through with the statement of profit or loss. So here, talking about components. Financial statements. The first one was the statement of profit or loss and other comprehensive incomes, in short, what we've just discussed. Then we have the statement of changes in equity. Now, the statement of profit or loss was made up of incomes and expenses and profit. Incomes, expense, and profit. The statement of changes in equity. The term equity, as the key term there, is the interest of the owner of the business in that business, or what does the owner of the business really claim to own in the assets of that particular business. Another word, a common term used there, is the word capital. But the more accurate term in financial wise is the term equity. This statement gives us a breakdown or analysis of how the owner's equity or capital keeps on changing from one year to the next. What happens to change the owner's investment in that company? Yes, the owner buys shares in the company makes a profit, so the owner has a claim or a share in that profit. There may be some changes, gains and losses in the value of the property or assets in that particular company. As the value of the assets fluctuates, so does also the equity of the owner of the business fluctuate. So we need a statement that shows how enriched the person becomes or impoverished the owner becomes with the losses and profits and gains that take place in that business. We have a statement of financial position. That statement of financial position will be having assets and liabilities. Let's briefly take a look at the statement of changes in equity before we analyze the financial position. Here are the items that make the statement of changes in equity. It's now available. the ownership interest or the interest of the shareholders. Let me use the term shareholders in the case of a company. They are the owners of the company. The interest of the shareholders is broken down into different accounts or different categories. One category is the share capital. The other category is the retained earnings. That is the profit that was made by the company in the past and it was not shared out. It's intact in the company and it belongs to the shareholders. Revaluation surplus. As we keep revaluing the company up, down to follow the market trends, sometimes we value the assets upwards and we end up with a revaluation surplus or reserve. So that those gains are reserved. They're not taken out of the company. Then now there will be the total of the share capital plus the retained earnings, the revaluation reserves, the total showing the total amount which is owned by the owners of the company. As I mentioned earlier, this equity does not remain constant. It keeps on changing. And the factors that may change it may be, one, when we make some corrections or when we change our accounting methods or accounting policies, sometimes we find that we have to change the figures or the amounts making up the owner's equity. When the company pays dividends, of course, the equity that remains in the company is reduced. So you can see a line there, dividends, the amount is a deduction. When the company makes profit in that year, it adds, of course, to the equity. And that's what we are calling there total comprehensive income for the year. That is how much additional income the company made during the year. This will increase the owner's equity. This statement will show us a comparison between the equity of 1 year and the equity of another year. So it's most likely to be presented in form of two statements, like changes in equity in 2016 and then changes in equity in 2017, so that the users are able to make comparisons. The next statement, we'll have the statement. We have the statement of financial position. The term financial position refers to the position of the assets, the liabilities, and the equity of the company. Three things: assets, liabilities, and the equity of the company at a given date. Let's say 31st December of 2018, or depending on the end of the financial period of the company, which could be, for example, 30 June of 2019. If that's the end of the financial period, then that's the date when we prepare the statement of financial position. What does this statement tell us? Three things: assets, liabilities, and equity. But this IAS 1 is not just concerned with you having the assets, liabilities, and equity there, but also how you are going to present them. These assets, liabilities, equity must be presented in a certain orderly manner, and it must conform to IAS 1, that is accounting standard number 1. First of all, assets must be presented separately as a group from liabilities and separately from the equity. Secondly, assets themselves must be grouped or classified under the current and non-current assets. We did that in financial accounting, even the most elementary level. Assets must be broken down into non-current assets and the current assets. Liabilities, similarly, between non-current liabilities and current liabilities. Equity, we have to give certain minimum information, the share capital, and those other components of the equity we called reserves. Now, very briefly then, take a look at the presentation that is given by the standard number 1 there. We have 2016, 2015. Take 2015 as the year of report, the year where we are producing financial reports, and 2015 as a comparison, what we call comparative information, looking back there to see where we come from. As I said, the assets are going to be divided into non-current assets and current assets. Within the non-current assets, very quickly, there are certain acceptable terms or headings. So we are not free to use our own terms there. There are terms which are used. Whatever we have has to fit under one or other of those categories. So we have like non-current assets, we have property, plant, and equipment. So you cannot, for example, put the word land or building there. It must be under the term included within property, plant, and equipment. There's a difference between the way you're going to have to approach accounting at CPA Part 2 and the way you approach it at the other level, the first level, when you're doing financial accounting. Because in financial accounting, you are preparing financial statements mainly for what? For internal use. And when information is for internal use, what is the number one thing? Detail. The information is very, very detailed and too specific. Yeah? You need to show how much furniture you have there. You need to show the value of the computers you have there. But at this level, we are dealing with information that is published, and therefore it's very greatly compressed or summarized. That's what creates the need now for the grouping that the standard number 1 gives us, IS1. So then to continue, like the non-current assets will be either property, plant, equipment, or goodwill, or other intangible assets, investments in associates, available for sale investments. Now this gives you a range of the categories under which you try to fit in any information about non-current assets. And then for the current assets, they have to be fitted under either inventories, receivables, other current assets, or cash and cash equivalents. That language must be very specifically kept. So from this point on, when you're learning accounting, learn accounting with those particular terms in mind for purpose of presentation. Then, of course, the sum total of all the assets will be given after that. What follows is the other side of the accounting equation. You are taught in financial accounting that statement of financial position is presented on the basis of what? The accounting equation. What was the accounting equation? Assets on one hand equal equity and liabilities on the other hand. So having gotten the sum total of the assets, you have to present what's on the other side of the coin, what's on the other side of the equation, and that is the equity and liabilities. Equity represents what? The interest of the owners of the company, like shareholders in that company, the economic interest, what they own in that company, not just the powers they can exercise, what they own economically in that company. That is the equity. Then that equity is broken down into the share capital. That is the amount the shareholders invested in the company to become members of the company. Let me use layman's language. That is what we call the share capital. Then we have got that capital that they have built up, the equity they have built up with time through the company making profits and retaining that profit in the company, the values of the assets appreciating, all those added together, they make what we call equity. Now this is it. Equity attributable to owners of the parent, share capital, other reserves, retained earnings. Non-controlling interest here means the amount of capital owned by minority shareholders in the company. That we shall discuss more details when we talk about group accounts. What about liabilities? We're given there non-current, and also we're given current liabilities. What are liabilities? Yeah, amounts which are owed by the company to other parties as a result of past activities or commitments. Now these commitments create two different kinds of obligation. We have the non-current liabilities. Non-current liabilities are those financial obligations that will involve the company paying or giving out resources for settlement over a period beyond 1 year. Then the opposite of that, the liabilities, the short-term obligations will have to settle within the next 12 months. Those are termed current liabilities. Then the key terms that you expect to be seeing here, or you expect to be using when you are reporting those liabilities. I told you a standard is there to tell us what language to use, and we don't use our own different terms. We have here, for example, a non-current liabilities. We have long-term borrowings, we have deferred tax, long-term provisions. That is, those are the key terms that we use under that category. Then under the current liabilities, the key terms are trade and other payables, which we are calling maybe creditors. Then we have got short-term borrowings, that is loans which are payable within like a year or months. Then current portion of long-term borrowings. Long-term borrowings that have come near now to their date of what? Maturity. even a 5-year loan, there comes a time when there are a few months left to settle that liability. So that it becomes a current liability. We have the taxes that we pay monthly and annually. We call those the current taxes. Okay, the current tax payable. Then we have got what we call short-term provisions. Above those three are part of the 4 primary financial statements. The 4th financial statement, which we'll not discuss in details at this stage, is the statement of cash flows. Briefly, a statement that presents cash inflows of the company, cash outflows of the company, and showing us a comparison how the amount of cash we had at the end of the last year and the end of the current year has changed, whether there's been an increase or there's been a decrease in the amount of cash resources held by the company. Our dear learners, this is the much we can discuss at a point like this. We are really trying to welcome you, create a platform for you to learn. We'll be discussing this in much more detail from the next session. Before I leave, I again want to say you're most welcome. You are in good hands if you are with the RCM team. Very good hands. They are not only tutors, they are consultants in different forums. So I would say, from my own knowledge and understanding as a tutor, you are in safe hands. We are going to prepare you for examinations. We are also going to prepare you to be good accountants. There's a lot more that you're going to experience. For that matter, also, if you're happy that you're with us and you think we can get along well, why don't you also invite others to join this program? I have not engaged you today with questions because I was only making an introduction. Let me also mention something here. We have one great resource here. We have one great resource. And what is it? Study material. Two categories of study material. We have got study guides, that is textbooks, and we also have revision guides written by the same team. Very, very experienced and qualified team of lecturers. And I would also tell you from my perspective as a tutor that these are worthwhile reference materials that should not waste an opportunity. A study guide costs 1,500 shillings. A revision guide costs 1,000 shillings. That is fair price by any means. I stand to be corrected. If you go through it and find that it's not of quality, I stand to be challenged and to be corrected. On that note, I'm going to say thank you for being with us and welcome, and much more is to come. Thank you very much.